I did just want to point out we did have somebody request the minefield slide. So if you don't mind sharing that or pointing folks to where they can find it.
Yeah, and so the minefields are a few different things. We had an HBR article on minefields. That's in the pre-work section of the web portal. And then the quick kind of financial red flag slide that we produced is up in the interactive agenda as well in the DNO line item, along with Dave Curtin's slides and PowerPoints as well. But you'll have access to all the collateral materials and slides and PowerPoints and things in the web portal for at least several weeks. And with that, let's jump into it. You know, what is financial acumen? We have a brand new definition here on day 4. You see it up on the screen. All the stuff we covered over the last 3 days, including the stuff from today. So that's our new definition. And, you know, you've been in there slogging through all the details, running the company, and just hopefully picked up some great takeaways that you can use in your real world jobs and in your life. You know, I'm a big fan of that. I keep saying it. I think financial acumen is important in life. Checkbooks, buying houses, managing investments, all this information is very valuable. I want to see how you did on the poll specifically. Oh, nice. So inspired by, I think it was Kelvin who made the Yeti joke, I went out and Googled. The first 5 are ones that we just made up, but number 6 I actually Googled. Is pretty funny, a 6-pack of abdominal snowmen. So that was inspired by the humor used on day 1 of "we're not ready yet," or "we'll see the results Yeti," making the joke about the Yeti. So it looks like the Bigfoot Ale from Sierra Nevada gets the 9, the highest score. So good job on the poll. And you could be drinking some of that if you win out of your Yeti cup. There it is. All right. So thank you for taking the poll. I believe, Max, all the teams have got us their performance measures. Is that correct?
Excuse me, could you say that again?
Yeah, I think that all the teams, from what I saw in the emails, and I forwarded a few to you, have got us their performance measures.
I think so, and the ones that you asked questions, I haven't checked if they resubmitted.
Yeah, there was at least one team that resubmitted when they understood that you don't have to choose everything. But I think we're in good shape. Looked at them. You've complied with the rules and regulations of the performance sheets, and so we'll see how this plays out at the end of the day as we award Yetis and beer bottle openers. Okay. With that, let's jump into it, because Max and I had a really good conversation this morning and yesterday as well about not only the metrics that the teams are choosing as they kind of strategically think about the process and the metrics that fit for their mission, but also just the way that the last round played out. And we're opening that up to you as you go into period 8, just a very quick lightning round that you'll do. But we want to go over some of the results that we're seeing and some of the observations that we had on the results of period 7. So here it is, and this is what you're going to see when you go into your team rooms. Let me walk you through just a few of the numbers that kind of jumped out at me, and then Max too, if you'd like to show some bar charts. I know you're looking at some metrics as well based on the debrief that you did yesterday, the great overview of the DuPont formula and things like that we're using in the scoring. But here are a few things that are jumping out at me. You know, they're pretty obvious, pretty high level, but you have some differences in income levels across the teams. And that's obviously one of the first things that analysts and investors look at. And they think, hey, is the company creating value? Because that profit opportunity feeds into retained earnings, to earnings per share for shareholders. So net income is a pretty important thing. Now, the dollar figure itself, yeah, we want to compare it to revenue and think about return on sales or profit margin, net profit margin. And that's one of the metrics that we're using in that DuPont formula that you're being measured on. So it's a very important component of that formula. You see how the teams are playing out on a dollar perspective. You can do the math or look a little bit deeper and get that ROS percent for each of the teams. Let me show you, if I go into firm D, how you could get that number if you look at the income statement. It's actually given to you, and this is interesting. I didn't realize, but I just pulled this up. And notice that for firm D, if you look at the metric down here on the last line, there's your dollar profit from what we were just looking at. But in the sim, we actually give you the return on sales. So that 7.5% is that 3,224 divided by the sales number at the top, the 42. So, you know, when you look at all these different businesses, you've already got some of the metrics calculated for you, but things like ROA, things like asset turnover, you can go ahead and calculate those yourself. Leverage, one of the metrics in the DuPont model. Sorry, Max?
Yes, I was just gonna say that with the profit margins in this industry, I bet many of the attendees are happy to be in the insurance industry.
Yeah, so they're a little on the low side?
Well, yeah, on manufacturing, yes.
Yeah, and I think actually, I'm glad you brought that up, Max, because we had a question from one of the teams about, speaking of different industries, right? Manufacturing, insurance, what are some of the common metrics that are used in different industries? And actually, I kind of just jotted as I thought about it this morning after reading the question, a few ideas on that. So let me pause the review of StratSim for a second and just kind of go ahead and leverage off of that point. Now that you mentioned it, Max, I think it's good to talk about it. So, you know, you notice that Firm D had a 7.5% net profit margin. I think I mentioned either to one of the teams yesterday or to the entire group that an analysis that was done a few years ago that I happened to look at said that across all industries, not just manufacturing or insurance, 7.5% weirdly happens to be the average return on sales number across the S&P 500. Now that was a couple of years ago. I don't know what it is today, and certainly with everything going on, that number wouldn't hold water probably. But as a benchmark, it's amazing that you happen to hit that exact number. So, but yeah, what are some averages in the industry? What are averages in the insurance industry? You want to compare apples to apples, like we talked about in the video. You know, you want to make sure if you're looking at manufacturing companies, you're not going to compare the numbers to insurance because those have fundamentally different structures in their businesses. One is heavy manufacturing, the other is insurance. So with that in mind, what are some common metrics that industries tend to focus on? Just a few notes. Some of the kind of generic ones that all companies think about, really, regardless of the industry, things like obviously the number we just talked about, return on sales. Cash, obviously, any business, large or small, is going to pay attention to cash. Free cash flow is another metric. And I know that we've thrown out that word a few times and in the various presentations. So what is free cash flow? Specifically, here's what it is. I wanted to make sure we didn't leave today without you getting an actual definition of what free cash flow is and why it's important. We mentioned yesterday, it's not just cash flow, because I could borrow a bunch of money, I could issue a ton of equity and generate a ton of cash, and that might be fine, but what I really want to know when I'm thinking about free cash flow is cash flow from operations minus capital expenditures I need to do to keep the business going. And that's what free cash flow is. It's freed up to use that cash that's left over if you have a need to do other things like pay dividends, buy back shares, etc., pay off debt. So there are things you can do. That's why free cash flow is such a focus in industry. So you want to kind of be thinking about free cash flow. And I don't care what industry you're in, it's a very common metric that's used certainly by analysts and investors as they analyze companies. You know, so free cash flow, current ratio, which is one of the metrics that we had in our little video overview. What are our total current assets compared to total current liabilities? I want to have at least a 2-to-1 ratio there so I can meet my short-term obligations. Dave Curtin mentioned that metric yesterday. Very important one. I don't care what industry you're in. Debt to equity, we talked about that, and we talked about leverage, which is kind of a different way of looking at your debt to equity, comparing the two. That's very important for any business. So I think those are sort of the ones that I don't care what business you're in. There are probably others. But now if I were to say, all right, what if we talk about manufacturing versus insurance versus agencies, the companies that you're working at, versus, and I threw in high tech only because that's a very interesting dynamic to look at. Manufacturing companies think about inventory turns, asset turnover, but also inventories. Are you getting that inventory out the door? That's a very important metric. ROA, return on assets. You got a lot of assets because you're making stuff. You have plants, you have warehouses, you have all these assets. How well am I doing at managing those to generate a return? Very important metric. And then RONA, return on net assets, is a version of ROA that is used a lot to think about, again, just kind of a deeper cut on what is going on with the use of the net assets, getting rid of things like cash, and talking about for the manufacturing type company that has a lot of fixed assets that they're employing. If I were to go to insurance companies, I'm talking about carriers, I would say that underwriting profit, obviously on the selling insurance policies, what is the underwriting profit? Not just profit of the company. If you throw in investments, that can change the picture. So what is the underwriting profit being generated? What is the loss ratio that you, I'm sure, look at on a regular basis in the policies you're writing? Loss ratios, underwriting ratios, and the overall combined ratio, common metrics for insurance carriers. Return on assets, very important for carriers, but a little different than a manufacturing company. Manufacturing company's got a lot of assets, plants, and machines. What's the return on those? Insurance company, a carrier, doesn't have a lot of machines and buildings, but what they do have is they have invested assets. They invest in treasuries and bonds and some equities. You want to know the income that or the return that you're generating on those invested assets. And that kind of ties into what I was sort of talking about yesterday. If you look at insurance, kind of a red flag for insurance carrier would be if you have those invested assets, get outside of that safety range and more into like derivatives and alternative investments that could be it can take down companies. It's part of what AIG had a problem with in the 2009 time period, is those invested assets. The other thing for a carrier, premiums to surplus being essentially equity. So that discussion of equity is not only about manufacturing, it's also carriers thinking about what they really own of that company. What do they not owe to creditors, but actually own in terms of the assets, their concept of equity. And then it just kind of...
Hey, Dave, I was going to hop in real quickly and just talk a little bit about from just a carrier perspective, because obviously we assume so much risk on the front end in just the nature of our business. We are very conservative, as you were suggesting, very conservatively invested on the back end. And obviously what's happened in the bond market of late, our returns have been on a decreasing basis, which really puts a lot of pressure. Then we have to, where do you make that up? It really then gets made up in the combined ratio. So it puts more pressure on the underwriting results piece to get to those ROEs that we need for the shareholders. So as we talk about rate increases and all that, that's some of the pressure that's kind of playing forward. So it's just a little bit more color commentary on how we kind of balance and manage the financial piece.
Yeah, that's glad you jumped in with that, because from that end, it's how you manage those expenses, which means that it's cost cutting, it's thinking about efficiencies on your expense ratio, which is part of that combined ratio. And then also losses, maybe some coverage changes. I know that Dave Curtin was talking about some of this as well. He's talking about rate increases. I mean, those are kind of the levers, numerator and denominator management, of looking at a combined ratio and what you can actually manage. So yeah, there are changes. I mean, banks are going through, Kathleen, as you said, huge changes in their strategies too, because they do have a lot of invested assets and they got to think about the returns that they're getting. Plus, if rates go down, obviously you're not you're not only not generating the returns on the invested assets, but if you're loaning money like a bank does, you're not getting the returns, the interest. So those were just a few things. And if I jump into the agencies, all these metrics make a whole lot of sense for an agency as well. There's one other one that I just wanted to make sure that we put up because Dave Curtin mentioned it, and I think I might have had it in the video. I know we used this term a few times. EBITDA or EBITDA is another kind of way of looking at this. But EBITDA is a term that David used. I use it, for agencies. It's a very important way of looking at your profitability. And what it's getting at is the earnings or profitability before you take out some of the corporate level type decisions, things like interest that you're paying on your debt structure, things like taxes. What is your tax, structure, and what are your strategies? Depreciation, do you accelerate or straight line? So these kind of CFO level kind of corporate financial decisions that companies make, that's all important stuff. But what about, here's the reason EBITDA is so important. What about if you just want to look at the core of the operations of the business, the agency? I want to take out some of that corporate stuff. We'll get back to that in a minute. But for now, what is the core operating, hence it's often called operating profit? What is the core operating profit being generated by the stuff that we do? And I don't care what kind of business you are, agency or manufacturing, you can look at this number.
Hey, Dave.
Yeah.
Just want to jump in here. Just from the manufacturing perspective, we have clients that put a lot of emphasis on EBITDA as well on their managers because, at the management level, they don't take any decisions on the interest or the taxes. That's corporate, right? So they don't want to confuse people by the bottom line. They say you have to produce EBITDA and let us take those corporate decisions at the C level, right? So we're going to decide how are we going to manage our debt, hence our interest. We're going to decide how the depreciation is going to be handled and our taxes. So you just make sure you're producing enough operating profit.
Good point. Glad you brought it up too, because I think it ties into the DuPont formula too. So the idea of EBITDA is, if you're going to incentivize people or have them pay attention to this metric, the reason is then they're going to pay attention to the things they have to do to manage and optimize the operations of the business without, as you said, Max, being distracted by worrying about interest rates on debt and taxes. So it's a way to get very focused and get people focusing on what they can control if they pay attention to it. That's also the thinking right behind that DuPont model that we introduced you in the video, and Max, you went over it as well. In fact, you had a good observation today too, and I'll let you make that in a second about what the teams are doing in terms of that model. That DuPont model, though, is all about getting that weird kind of high-level ROE metric, exciting and fun though it is. What impact do I, as an operating plant manager, let's say, really have on that metric? Really none, right? Well, no, actually, if you pay attention to the three, and I think I actually have the slide ready. If you pay attention to the three components of, the DuPont model, here it is. Here we go. If you pay attention to the three components, right, and I'll come back to that in a second, of the DuPont model, boom, at an operating level, as you manage total asset turnover, the middle metric there, as you manage financial leverage, as you manage net profit margin, focus on those things. Hey, I come out with net income over equity, which means I have almost by default, almost on accident, if I manage these three metrics, I've come out to maximize ROE. So let me just go back up real quickly.
David,
Max,
may I just say something?
Sure.
Yeah. So, and here's another good example of why the DuPont is important for managers, because it tells you the levers that you can actually pull to make your business unit better, right? You increase profits. So you're managing pricing, you're managing the amount of widgets that you're selling. So that is measured with ROS. The second thing you could do is you have to manage very well those assets. You don't want to have a lot of inventory sitting around. You don't want to have or a lot of investments in plant and equipment that you're not going to be using. So you have to keep your assets tight, and that will be measured by your total asset turnover. And now leverage, that is going to be how you're managing your debt levels and how much are you using outside money to fund your operations. And the reason why here we use that is because you are the CEOs of this company, right? So you are actually managing this. So but usually at companies, I think financial leverage is always not at the operating level, but it's more of on the C-suite.
Yeah, good. And just to quickly go over, I mean, I think those metrics are defined in the ratio itself, but just to review, because you are being measured on these, and you've all been asked to focus on those three components of the DuPont model as you run this company, and certainly into this last lightning round. So real quickly, here's your definition, quick review: return on sales, net profit after taxes divided by net sales. Boom. Next metric, asset turnover, net sales again, but now compared to total assets. Reminder, total assets includes cash, includes inventory, includes accounts receivable, includes goodwill. Now, you don't have that in the sim. I don't think it's come up, but in the real world, that would be part of total assets. You really got to think about the components of total assets. Final metric, leverage or gearing, and we had this kind of laid out for you in one of the videos and broken down in terms of how this thing works, but this is the final component. And you know, your assets divided by equity, and what are you doing to finance your assets through equity or debt, all playing into that DuPont model. I think, Max, instead of me doing another quick, run through of observations, you had some bar charts to show, and just in the interest of time, could you do a quick couple of minutes walk through some of the bar charts? I want to keep that just to a couple of minutes, Max. Sorry, I used up some of your time. So Max, you still there?
Can you hear me, Dave?
Now I can hear you, yes.
Thank you. Sorry, I was just sharing my screen, and can you see
No
uh, my screen right now?
Yes, I can see the bars. Good, go for it.
Don't worry, this won't take long. We just wanted the teams to remember that you all started the same. Everybody had the same sales, everybody had the same vehicles, the same profitability, the same amount of love. But now in period 8, we have seen now companies go different ways, and you can see now the difference in terms of sales. And what we're seeing right now is throughout the 3 periods that you have made decisions, we're plotting each period sales, and we can see that entering in our last round of the competition, firm D is leading in terms of sales dollars. Okay, now here net income, so this is the bottom line, net profitability, net income. Again, firm D is doing very, very well, followed by firm G and firm A. Now, some of the DuPont uh, metrics that you're going to be and you have already chosen, actually, we see return on sales, high profitability, definitely, and in respect to sales, we see that firm D is actually leading in this metric. We see that asset turnover, it seems that firm G is actually the one that is managing better their assets to return those sales. So closely followed by firm D and firm A. And we have leverage here. We see some of the teams probably paying out some of that debt or even decreasing some of that equity. And so in this case, because we're trying to manage our ROE, leverage is good up to a point, and it seems that teams are managing very, very well over here. And return on assets, very related to return on asset turnover, sorry. Again, firm in this one in particular, so firm D is better at returning profits from their assets, but firm G, as we saw, was better at returning sales from their assets. But it seems that both companies are managing very well their assets and what they're doing with them. And firm C, before you get very excited, inventory days, that's lower is better, right? We don't want to have a lot of those in sitting around. So it seems that in terms of inventory, firm G is actually doing a great job. Either they having a better outlook of the future, their estimates on how much production, or they have better cars, people are actually buying them, and so they don't have a lot of inventory in terms of that. So that it just gives you an idea of where you stand right now compared to other competitors. And
Hey, Max,
yes,
do you mind going back on that one real quickly? And I just want to make sure, because you mentioned Team G in that one, but it looked like Team, I believe it was B. Um,
oh yes, thank you, sorry.
yeah, I just wanted to make sure because Team G has a little bit more kind of balance, but you can kind of see how Team B has managed that down. So
Thank you, thank you. You're right. I went through a little bit too fast on that one. It's actually B that is managing their inventory very well. But the assets that firm G is managing, probably they're managing not only their inventory, but how much they have in terms of manufacturing capacity. So probably that's why they have a better ROA, a better return on asset turnover, sorry. But yeah, inventory, firm B is doing a great job on that. Thanks, Kathleen, for that observation.
yep.
Um, again, so Dave, now that we have seen how the teams are actually performing against each other as they enter the last round of the competition, I'll let you explain how are we gonna do the final debrief. And you should have presenter rights right now.
Great, good. I'll share my screen, Max. Thank you.
You're
Look
welcome.
like it's coming through.
It is.
Period A competition and prep. That's showing, Max. Let's see, just might be muted. Kathleen, you hearing me? And
I am hearing you.
Yeah, Dave, we're seeing period 8 competition.
perfect. Good, good. Just sorry. Wanted the confirmation that the presenter switching worked right in our new virtual world. So yeah, period A competition coming up, but it's a pretty fast period. We're going to get you started in just a minute, but I wanted to explain not only what you're doing in that final lightning round of competitions, you make those final moves, you know, and I would say you do want to make sure you focus on the things that are going to make a difference in the final year, because things like brand new classes of cars, I wouldn't go investing in those. You're not going to get any return out of investment, as you well know at this point. It's going to take a couple of years and you don't have that. You want to focus on small things like advertising, dealer discounts, minor upgrades, cost reduction upgrades, things like that that can make a difference. Those fine tuning that telescope, bringing into focus the moon, the analogy I use with the bigger knob on the telescope, you've done that. Now it's time to the fine tuning, the super focus on what you're trying to accomplish, and keeping in mind the metrics that you've chosen and the weighting that you put on those. So we'd like you to be done at 1 o'clock Eastern time. We're going to advance the sim immediately after the round, lightning round is over at 1 o'clock, so that you can see period 8 results. You won't know what the teams have chosen as metrics. There's no way you could, you know, kind of figure out who's won. We're going to keep that for more of a surprise at the end. But as you go into the preparation for your earnings calls, we thought it was important that you actually saw the results of that final period for all the teams, not just for your company. So what we're going to do is give you a half hour to actually get in there and complete all your decisions for period 8. You only have a half hour, but then take a break, 15 minutes, whatever you might need, come back to your cloud rooms, and we'll have advanced the simulation, locked decisions, but you'll be able to see the results as you then spend another half hour preparing for your earnings calls. Okay, so, and then come back to this webinar, the live main room webinar at 1:45 for those earning calls that we'll have the teams do. And we'll announce the winner after that. And I'll put this slide back up in a second, but just to review what these earnings calls are about, we just want you, no PowerPoints, no fancy drawings, just speaking from the heart. speaking from the heart about your company verbally. Describe your company for maybe 3 minutes. We'll just go in order, team firm A through firm G. A quick verbal presentation to the entire group. Part one is talk about your company, 3 minutes. And this is available up on the interactive agenda on the web portal as a download if you want to look at it. And I'll leave this up on the screen when we get out of the room as well. Talk about your company, mission, strategies, financial metrics that you're focused on. And then here's what we'd like you to do, and here's why we want to make sure you can see the results of period 8. Look at your competitors' financial results. Which company would you, as an insurance agent, be most interested in prospecting as a client? So I want you to go beyond just the company you've been running, but look at the entire industry. Pick one company and let us know who you'd be most interested in talking to as a potential client. So taking all those red flags, all the concepts into account, this should be a fun result that we'll see out of that discussion. And then just real quickly, very short, we're talking about one bullet point out of all those reflections and takeaway exercises through the week. What's the one thing, just very quickly, one bullet point you're going to take away from a financial perspective out of all the discussions that we had over the last 3 days? So just a quick takeaway point from each team member. And if you want to give those points to the presenter, you don't all have to talk during this team presentation. I'd nominate one person to speak for the team and who can then, point 3, share each of those quick bullet point takeaways. So we'll put that back up on the screen in a second, but the timing is this. You got from now until 1 o'clock Eastern time to finish your results for period 8. Think about production too as another kind of lever you do want to pay attention to. You want to make sure you have enough cars that you're making to meet your projected demand for period 8. That's probably the most fundamental and important thing you can do in this round. Make sure that you're going to have enough cars so people can buy them. But then pay a little bit of attention to the other things too. The little bit of marketing, think about dealerships, things like that. Production being very important. 1 o'clock, we'll advance it as quickly as we can. Stay in your team rooms, take a little 15-minute break, prep for the earnings calls. You see you back in this webinar at 1:45. And we will be coming around to the team rooms as well to help you out during this time. And with that, any questions? I know we're going to go see one of the teams real quick, but Max, anything else, or Kathleen, you want to add?
No questions right now.
All righty.
Nothing on my end.
Okay, thank you. Back at this webinar 1:45, we'll come to the cloud rooms. Remember, this is what we want you to do after 1 o'clock. Thanks a lot. See you in the cloud rooms.